Hi everyone, and welcome back to Accounting Insights with Rula. Today, we're diving into some practice problems on financial statements. Feel free to pause the video, try the questions independently, and then hit play again to go over the solutions together. Let's jump in and get started. Now that we've covered the basics, let's turn to real-world examples. I want to introduce you to Mr. Bariq, who will be guiding us from here. All the problems we'll tackle are from his company, and he's eager to help us understand how to handle transactions and prepare financial statements. We've collected financial data that needs to be organized into an income statement. Could you arrange these figures to show the company's performance? Let's take a look at the solution. The income statement shows a fee income of $40,000 and total expenses of $28,000. Net income after subtracting expenses from revenue is $12,000. What would the net income or net loss be if an additional $15,000 rent expense is included? Let's find out the answer. If we add $15,000 rent expense, our total expenses rise to $43,000. This means our net income would turn into a net loss of $3,000. It's important to note that when expenses exceed income, a net loss occurs. This will lead to a reduction in capital. Imagine Mr. Bariq's company earned $14,000 in fees income, but had to cover expenses including rent, salaries, and miscellaneous costs. Additionally, Mr. Bariq decided to withdraw $2,000 from the company. Using this information, let's determine whether the company's capital has increased or decreased. To begin with, the company earned $14,000 in fee income. After covering total expenses of $8,000, the remaining net income is $6,000. Since Mr. Bariq withdrew $2,000, we reduced this amount further. The company's capital has ultimately increased by $4,000, reflecting the net gain after all expenses and the owner's withdrawal have been accounted for. Let's look at what happens to capital based on net income and drawings. Imagine this. If your net income is greater than your drawings, then you are growing your capital. This means you're making more than what you're taking out, which increases capital. But if your net income is less than your drawings, or if there is a net loss, then it's a different story. Here you're either not earning enough to cover what's being drawn or even losing money. In this case, there is a decrease in capital because more is leaving the business than coming in. If Mr. Bariq decided to withdraw $9,000 instead of $2,000, what would the increase or decrease become in capital? The net income of $6,000 would be reduced by $9,000, resulting in a $3,000 decrease in the company's capital. Based on the following information, calculate the capital as of December 31st. As of January 1st, the capital stood at $20,000. Adding the net income of $18,000 bring this amount to $38,000. After subtracting the drawings of $6,000, we see an overall increase in capital because the net income exceeds the drawings. Therefore, the capital as of December 31st is $32,000. Based on the information provided, determine the capital on December 31st. Let's review the answer. The total assets, which consist of cash, supplies, and equipment, amount to $14,400. The total liabilities made up of accounts payable and notes payable are $7,000. According to the accounting equation, assets equal liabilities plus owner's equity, we determine the capital by subtracting total liabilities from total assets. Thus, the capital is $7,400. Mr. Bariq's company had the following balances on January 1st and January 31st. What was the company's net income with no withdrawals during the month? This question encourages us to apply critical thinking. Let's go through the solution step by step. Here's what we know. We have the company's assets and liabilities for January 1st and January 31st, and importantly, there were no withdrawals during this month. This means we can focus solely on the change in capital to find the net income. Let's review a key concept, the equity equation. Net income minus drawings equal change in capital. Since there were no drawings this month, the change in capital from the start to the end of January will be exactly equal to the net income. To find the capital at the beginning and at the end of the month, we'll use the basic accounting equation, assets equal liabilities plus owner's equity. Starting with January 1st, if we subtract liabilities from assets, we find that the capital on January 1st is $12,000 and on January 31st is $16,000. The change in capital by subtracting the starting capital from the ending capital gives us $4,000. This capital increase represents the net income since no withdrawals would otherwise affect capital. If $1,500 was withdrawn from the company, can you determine the net income? Using the equity equation, net income minus drawings equal change in capital. The change in capital is $4,000. Since $1,500 was withdrawn, we substitute into the equation net income minus $1,500 equal $4,000. Solving for net income, we find that it equals $5,500. Review the income statement for Mr. Bariq's company provided below. Certain figures have been left out. Place the correct amount needed in each of the blanks. Let's go through the answer together. Total operating expenses represent the sum of all the costs a company incurs in its day-to-day operations. Net income is calculated by taking the income the company earns from its fees and subtracting all the operating expenses. Essentially, it's what's left over after covering all the costs of running the business. In this case, the total operating expenses are $40,300 and net income is $26,400. Let's take a look at the statement of owner's equity and fill in the blank with the right amount. First off, we calculate the capital increase by taking the net income and subtracting any withdrawals. That gives us $6,400. To find the capital on December 31st, we just add this increase to the starting capital balance, which brings us to $24,400. Let's work through the balance sheet together and fill in the missing numbers. First, we need to figure out the accounts receivables in the assets section. We know that total assets should add up to $29,700 and we already have amounts for cash and supplies. So if we subtract these known amounts from the total assets, we're left with $13,000 for accounts receivables. Next, let's look at the liabilities and owner's equity side. We add up accounts payable and notes payable, giving us total liabilities of $5,300. To find capital, we simply take total assets and subtract total liabilities, which leaves us with $24,400. With that, we've completed the balance sheet. Our total liabilities and owner's equity match total assets at $29,700, so everything balances perfectly. I hope you enjoyed the review questions on financial statements. Thanks for joining me. Goodbye.